Okay, well, let's get started. All right. All right, hi everybody. We're going to start our webinar on the Bradford Point apartment investment in Evansville, Indiana. Before we start, we should go over a few housekeeping items. Okay, first we'd like to let you know that we're going to have a question and answer session at the end of this presentation. So if you have a question, please click the Q&A button, and then you can type in your question there, and we'll try to answer it at the end if we have time left. Okay, and next, please be aware of a few legal items. Okay, this offer is for accredited investors only. And also this webinar contains projections and financial estimates that we think are reliable, but they are projections only, and we can't guarantee the results. Also, if you're interested in this transaction, you can only participate after you receive and review our PPM and subscription documents. So you can contact one of us to get these documents, and those documents will contain more thorough information. So you should definitely review them. Okay, and with that, let's start with the financial highlight of this exciting investment. Okay, as you know, multifamily as an asset class has become very competitive, and it's been very difficult to find a multifamily asset that makes financial sense and has the kind of potential numbers that we see here. This is a 252 units, mostly 2 bedrooms, apartment building in a B-class neighborhood. Our partner, Michael James, obtained this property through his local relationship in Evansville, Indiana. We're purchasing it for $6.45 million and planning an approximately $1.25 million renovation. It is currently undermanaged, and we plan to improve the performance of this apartment by professional and strategic management by our partners, JMG Management Group. Okay, we're expecting 8 to 12% cash-on-cash return per year from operations. 8% the first year and increasingly slowly thereafter as we slowly raise rents. Now, this cash flow from operation is equivalent to more like 12 to 15% ROI, depending on your tax situation and rate. So the cash flow is actually substantially higher if you want to compare to a fully taxable income. We can go into a little bit more detail later on in this presentation as to why that's the case. But this is one of the most exciting aspects of real estate investments cash flow, the tax efficiency of it. Our projected IRR is approximately 16 to 17%, and annualized cash-on-cash return for the investment is over 36%. The planned hold period for this investment is about 7 years. As always, this could be earlier or later, but this is our best projection as of now. Now, I'd like to quickly introduce the sponsor team. There's me, I'm Sonia Lee. I've been in real estate investor and developer for 17 years. I started investing and developing residential homes and more recently founded Leeward REI to provide a platform for individuals such as yourselves so that we can have opportunities to invest in institutional level real assets like the one we have here. Matt Olson is co-principal of Leeward REI, and he's also my husband and life partner. Matt's been practicing real estate law for over 20 years and more recently joined Leeward REI full-time to help expand and improve our operations. For this project, we have a special partner, Dr. Felicia Froh. Dr. Froh has been practicing medicine as urologist for over 25 years and has served in various prestigious positions in the medical field, including being the chief of staff at Kaiser Permanente. Like me, she also shares her investment knowledge and helps busy professionals find opportunities and guides them to deploy capital into cash flowing real assets. Welcome to Dr. Fro, and thank you for connecting us with your investors today. Now we have James Management Group. Michael James is the president and founder of JMG Group. Since finding JMG Group, Michael has been actively pursuing and aggressively managing underperforming multifamily properties in the Midwest. He's been building up a great team, has a wide network in Indiana, and he personally oversees all constructions and rehab work. Michael oversaw purchase and management of over 4,000 combined units to date. We also have from his team, Jerry Goodrow, Director of Investor Relations, and Bob Milford, VP of Acquisitions. We'll hear from them as well during this presentation. Okay, now with that, I'd like to turn the mic to Michael, who's going to tell us about this property specifically, as well as City of Evansville and what it all means to us in terms of this investment. Michael?
Good, thank you, Sonia. This is Michael James. I'm here with Jerry Goodrow, and we wanted to start out telling you a little bit about the history of James Management Group. JMG is a company that invests in value-add workforce housing that would be normally called multifamily housing. We've been investing in this type of asset for a little over 20 years, starting in Northern California, working the Bay Area, up into Sacramento, down into Fresno, Bakersfield, and other cities in the 99 corridor in California. During that time, we also invested in the Mesa and Phoenix area of Arizona. Approximately about 13 years ago, we decided to move all of our business interests to the Midwest, and specifically after studying demographics into the Indiana area. Since moving to Indiana, we've purchased and rehabbed 23 multifamily projects, over 3,000 units. We've sold over 1,500 units back to the market after a 7 to 10 year hold with great success. Today we own over 1,600 units with over 600 units in escrow to purchase at this time. Most of our management team, which is made up of 60 people, have been with us for an average of 8 years, which is it's very important in this business. And we've built a special culture of working as one team. And what you normally see in a management company is a lot of workers that work at each property, but they work individually to make their one property the best it can be. And that works to a point. But when you get 60 people that have each other's back and help each other from property to property, sharing marketing information and trends and different things that are happening in the market, now you have a team of people that's helping each property. You're not reinventing the wheel, and everything works smoothly. And part of that strategy is the fact, and we'll talk about it here in another minute, is that we don't fee manage for other people. We only manage our other properties. So let's dive into the strategy that James Management Group uses as we purchase property. So again, we've had a long-term successful niche by buying C+, B- properties in B neighborhoods. We then will perform a strategic rehab and upgrade to them to make them into B- B properties. And by doing this, we've created a better cap rate at the purchase and a much better cap rate after 12 to 18 months when we've stabilized the property. This makes all of our investments a safer purchase for our clients. This niche has also yielded above average returns and sold prices above predicted levels after a 7 to 10 year hold. And as I mentioned before, one of the main reasons we can be so focused on creating better profit and well-preserved assets is that we do not manage properties for others. And we only manage properties that we have our money in and our investors' money in. And so we're focused on that. And as any of you that have been involved in multifamily investments in the past, it's a good management and good oversight that's going to make our profits. So let's look into an overview on Bradford, the property that we're looking at today. Take a little deeper dive into that. As Sonia mentioned, Bradford Point's a 252-unit C-plus asset in a B neighborhood with 171,000 square feet of rentable space. Bradford's located in a general region of 97% occupancy and an area that is consistently leased at 94 to 95% with high demand. We are starting with rents that are $100 to $200 per month under market. And that's one of the greatest assets of this property as a purchase, is that we've got about $150 to $200 to use now in marketing, rehabbing to get up to market and make a profit for our investors. So as we look at the slides that you see on the screen, you can see that the building is in a mature single-family neighborhood with beautiful trees. The property looks almost brand new inside. 204 units were completely remodeled and rehabbed in 1995, and 48 more new units were built in 1996 to make up the total of 252. It has modern kitchens and baths. Every unit has a full laundry room and hookups, which is huge in our businesses. One of the biggest deterrents to renting is properties that don't have laundry, where people have to go out and find laundry or go to the laundry room across the street. The buildings are all vinyl siding, and we are adding a 4-foot brick wall to the ends of the units to make them look more aesthetic. This is a very modern leasing office and clubhouse that you're looking at, and the workout center is going to be rehabbed, and we're building a business center to add on to the clubhouse. As you look at the nearby amenities map, I wanted to just point out that the property is very close to East Lloyd Expressway, and Lloyd Expressway runs east and west right through the heart of Evansville, and the property is, as you see in the next page in the overview, right next to the University of Evansville. It's 3 miles from the downtown area and nearby hospitals and businesses. The property has full-size pool and sun deck, and as I mentioned, clubhouse and fitness center that we're rehabbing. The units inside have full-size kitchens, modern kitchens, and patios, and all units have central air and heat. So as we move forward now, I'd like to dig a little deeper into our strategy, starting with the renovation and where the property is now. One of the main reasons we're buying this property was that the owner, who lives in New York, he doesn't see the property often. He doesn't have a management company that's up to date in regards to how they run their company, poor marketing. They haven't been able to put down or units that are in need of rehab back into the marketplace in a 2 to 5 day period, which is normal in our business. And we're looking at the whole strategy of where this property is at, and half of it's a management play and half of it's the rehab play. So as we reclassify to a B class from a C, We've budgeted over $1.2 million to make this changeover, and we'll talk about in just a moment some of the items that we're rehabbing out of that $1.2 million. Our main play on this property is the fact that we're putting units back into the marketplace, 30 units that need to go back into the marketplace and be rented in the first couple months. We need to raise rents once we have those units back on the market. We also are going to collect rent in a different fashion. Right now, they do not evict tenants quickly enough and really just haven't put the hammer down to collect the rents on time. So as we put our management team to work, we'll be able to do all of those things on a timely manner, collect more rents, better occupancy, higher rents, and that's where we make our money while we keep in check our expenses. Some of our deal highlights, as Sonia mentioned and I've already mentioned, are one, that we purchased this property off market. So we didn't have to fight over price with other companies that were making an offer because it was not on the market at the time. I've got a relationship with 3 or 4 brokers in the Indiana area that bring me product, and I've been able to make offers on projects that are off market and get sellers to take our offers. So we're getting this property underpriced and under what it is, what it's valued at. Second, it's a high demand area for units. As I've mentioned before, the region's 97% and the area is 94 to 95%. So we know that by looking at the market and the other apartments in the area that we can drive occupancy up in this area. Next, we have assumed the last 5 years of a Freddie Mac loan at a fixed rate of 4.58%. I can't go out in the marketplace today and get that good rate on a fixed rate loan. So we've got 5 years of a good rate, and at that point, as a team and sponsor, we'll decide whether we're going to sell at that point or move on and refi and go another 2 years. Some of the key factors to this purchase were looking at the fact that we had a great value add opportunity ahead of us. We have great job growth, and mainly this is the #1 item for Evansville and Indiana at this moment, and that is that it has great job diversity. Job diversity is #1 on my list. It's how we were successful in California. It's how we were successful for the last 13 years in Indiana, and we follow job diversity, and Evansville has that for us. The other thing is that Evansville is in the middle of it's the hub of the tri-state area, Illinois, Kentucky, and Indiana, which Jerry's going to tell you a little more about, but there's 900,000 people in that hub, 300,000 in Evansville. And for those of you that are joining us from California, that's equal to the city of Bakersfield, to give you an idea of size and you know, where it's at. The last piece on key factors: money is made or lost with the management company. A good professional management company with people that care is what's going to drive a good investment. And we have that team, and we're ready to work on the property. Lastly, as you look at the market overview location, you kind of ask, well, why should we invest in the Midwest, and why should we invest in Indiana, and why should we invest in Evansville? First of all, the Midwest. As you take a look at this map, the Midwest, Indiana is right in the center of this hub. You've got Michigan up above, you've got Illinois to the west, Kentucky and Tennessee and Nashville to the south. You've got Louisville, Cincinnati, Columbus, Ohio, and it makes Indiana a hub to the Midwest. And we have great unit pricing versus rental rates. which create great cap rates, great entry-level cap rates, and as I mentioned before, even greater cap rates at the time of stabilization on our rehab. And then why Indiana? It's because Indiana is tax friendly and the government is friendly to new businesses and job growth. And they attract it, they go after it, and they've done a great job of bringing job diversity to Indiana and the Midwest. So the third item is why Evansville, and I'm going to turn that over to Jerry Goodrow, and he's going to tell you a little bit about Evansville and the Ohio River port and so on. So thanks, Jerry.
Thanks, Michael. Appreciate that. I want to talk a little about what I call the Evansville Ohio River Valley. And one of the things that you'll see from this is, it has long history. Evansville was built on the Ohio River, kind of have barge traffic all along, but people don't realize that barge traffic goes all the way down to the Gulf and all the way up through Cleveland, Ohio. So there's a lot of traffic that goes through there, and it's increasing, it seems like, yearly. And with the expansion of I-69 from basically 95% completed from Indianapolis all the way down to Evansville, and eventually up to Detroit, and then down to Mexico, it'll be a monster commerce for Evansville as times continue, especially in the upcoming years. One of the other things that's interesting with Evansville, you can see from these slides here on the left-hand side, is the port side of the Ohio River. They've done a lot of renovations. They put a nice brick path in there that basically goes along the river, and it just makes for, they're starting to spruce up the downtown. They've ripped down some buildings and started to do some major renovations. Some of those things include a new IU Health Center. Vectren put a new facility in there for a lab. The other thing that makes Evansville kind of interesting, Mike mentioned, is the fact that there's 900,000 people within a very short drive of Evansville. Evansville itself is 121,000. From a metro standpoint, it's 300,000. So just within the surrounding counties of Evansville, there's a lot of population to draw from, and Evansville being the center of that. Third largest city in Indiana. And it's just, I think it's going to be the next city to explode in Indiana. From a market overview, from an economic growth standpoint, you kind of look at, from a graph standpoint, a lot of people think that Indiana is very manufacturer driven, and that's probably just the opposite. If you look at Evansville, the decline in manufacturing and the increase in service industry, and I've got a chart that'll show this a little bit better on the next slide, but it shows the diversification within that marketplace. So it's healthy, it's diversified, and it's got a great economy. Downtown Evansville's got a new Ford Sports Center, part of their convention center. Just go to the last slide still one more time there, Matt. And part of that economic side of it, it doesn't really kind of show it there. It's kind of hard to see. But some of the other things they're doing in downtown Evansville is DoubleTree just put a brand new convention center hotel in. Tropicana just did a major expansion. Vectren, as I mentioned earlier, put a renewable testing lab in for renewable energy. And then IU Medical School. So those are all things that they're doing downtown Evansville. And if you look at my famous pie chart it kind of shows the job market. And I apologize for this picture, but I just couldn't squeeze it on this slide any better than I could. But it kind of shows that you look at manufacturing, that little pink triangle on the upper right, it's a small percentage of the overall population. And that's one of the reasons that James Management Group was attracted to Evansville. And we will hopefully continue to acquire other properties down there. A few of the major employers in Evansville. I'm not going to go through this whole list, but I'll point out the big ones. Deaconess Hospital, Vectren, and Mead Johnson, who's now owned by RB, which is their nutritional division, mainly infant formula, some other things. And RB is dumping, as of 2017, they've announced they're investing $25 million in increased capabilities and capacity within the Bristol Myers facility down in Evansville, which is good news from the healthcare side of it. If you look at job sources, You can just see where some of these things are located that I mentioned: Deaconess Hospital, Meade Johnson, University of Evansville, and Vectren Corporation. All major, facets of the Evansville marketplace. And with that, I will hand this back over to Michael James to go through more details on the financials and show you how you can make money with this.
Thanks, Jerry. If we go to the next slide, rent comparables, I'd like you to focus on the upper right 2-bedroom section side and look at the first graph. And Bradford Point Apartments sitting at an average of about $557 per month. And then secondly, look at the line that's drawn across the 2-bedroom market, which averages out at about $740, about $180 above Bradford Point. That $180 is the key to our investment. That's where we're going to make our money, and how we're going to get there is to get those 30 units back on, and then to collect properly, cutting down our loss to lease, collecting actual money and collecting the dollars that are supposed to come in the door, and raising the rents. And it sounds like 4 easy things to do, but it's a lot of work to get us to that stabilized point. On our assumptions and budget page next, I'd like to just run through some of the basics here of our purchase. And it shows you that we're buying the property for $6,450,000, our down payment of $2,050,000, our loan at 4.4, and at a 4.58% fixed rate. Our average rent starting against a market of 700 plus. And then other income that will grow through the collection of fees, and also the addition and the start of a RUBS program. This RUBS program is a utility bill back program, so that we bill back for water, sewer, and trash to our tenants. Secondly, over on the left, you'll see our project rehab of $1.256 million, where we're going to do some roofing, asphalt, brick siding, HVA work, balconies, and down through the list, but mainly some indoor amenities, outdoor amenities to make the property look better and more usable for our tenants. We've got approximately almost $100,000 in to turn the 30 vacant units that they have after we did our walkthrough. So we're ready to go to work on the property and make a profit. So next, what kind of profit can we target and project for Bradford Point? If you'll take a look at the top of the page under potential gross rent, you'll see that we've started off at $1,684,400. That is a blend of what the company that owns the property now is collecting, and the difference of putting the 30 units back into the marketplace during the first year, collecting rent in a better way, closing down the vacancy, and upping other income with the RUBS program. I'd also like to point out that if you look into year 6 on potential gross rent at $1,994,700, we're trying to under-promise and over-deliver, but that $1,994,000 is a number that James Management Group would like to see by year 4. Under operating expenses, we've used a blend between the ongoing expenses of the property now, making adjustments for things like maintenance and turnover, where they overspend by using third-party vendors, and James Management Group does most of their work. We are certified in heating and air, and we do all of our own work. And we've made some adjustments to landscaping, snow removal, property taxes, and things of that nature. So now let's move down to net operating income of $677,300, and then reserves 48. I just wanted to make a quick note that the reserve section all the way across 48, 58, 68, and so on is what we use for capital repairs each year. Years 1 and 2, we won't need as much for our capital repairs because we've got our rehab budget and we'll be doing that work. Then in years 3, 4, 5, and 6, you'll see that we've upped that budget. As our rehab budget runs out, we'll be using more capital repair reserves. Then our debt service on our 5-year Freddie Mac loan is consistent all the way across at 280, and our before tax cash flow. Down below, you'll see an 80-20 split, an 80% distributed to the investors and a 20% distributed to the sponsor for their work on the property. This 80-20 split is been devised so that it gives the investor a good cash flow, and it also gives the sponsor a way to make money by pushing the rents, by creating more value in the property. And we want to be motivated to do that for our investors. And we also want to be motivated to do that for ourselves. As you look across the investor cash on cash return at the bottom, if you look years 1 through 7, you'll see that after you do an averaging, it averages at about 10% cash flow per year. That will go up after tax because we do cost segregation so that all of our investors, if needed, can use depreciation and bonus depreciation. And after using that, your after-tax profits will be up in the 13 to 14% area. So let's move to the next slide, and we'll take a look at a few sales assumptions. Basically, at year 7, we're going to be looking at the middle of the upper slide where it says 7.25% in blue. This would be a sales price above that would be $13,760,000, and if you bring that down into the middle slide below, it shows you what you've made in cash flow for year 1, 2, 3, 4, 5, and 6. And then I want to show you cash flow year 7 and proceeds from the sale are all together in line 7. And then the last number at the bottom is the $4,025,000 being returned, your cash capital investment return to the investor. So at this time, let me hand it back to Sonia, and she's going to give you a little bit more information on how to follow up on this investment. So thank you.
All right, thank you, Michael. Those are very exciting numbers. I think it's a little overwhelming, but if you go back to that total proceeds after the exited capital event, it gives you the annualized return percentage of over 36%. So, and that's with a pretty conservative assumption of 7.25 cap rate, which, from California's perspective, it's very high. So I think those are numbers are very exciting, and I think Michael tried to restrain himself today. Michael and Jerry they both have wealth of knowledge, and one of our challenges in putting this webinar together is to shorten Michael's speech. So I encourage everybody to contact us, and Michael will have all sorts of good information if you have any follow-up questions. I'm sure of that. Okay, so let's talk about the capital we're going to raise and what those funds will be used for. Purchase price, as we mentioned, is $6.45 million, and this is less than 26,000 units per door. So hard to imagine for us Bay Area or LA folks out there, but as Michael said earlier, this is we're going to be raising rents on these units up to $650 per month, and that's just to keep up with the market. On $26,000 per unit, that's GRM equivalent to around 3.3, which, if you guys are familiar with the multifamily lingo, that's unheard of. Just to show you what that means, right now in the Bay Area, sometimes we look at GRMs of 17 or even 18. So this is a tremendous opportunity, and that's why we have to go where the opportunities are. Okay, in addition, we have some acquisition costs. Those are loan closing fees, loan fees, broker fees, and brokerage fee that's going to go to Michael James's company, which we'll talk about in a little bit, and sponsor acquisition fee, some legal fees, and then we have that renovation cost Michael talked about for CapEx of 1.25. And in addition, we have some working capital and reserve of $235,000. Okay, this brings the total fund we need for this project to be $8.425 million. Out of this 8.425 we need, we're going to assume a loan for 4.4 million at 4.6 rate. This is approximately 52% loan to value financing, so the leveraging structure is very conservative on this deal. The rest of the funds needed, which is a little over 4 million, will come from equity investors. In every deal we do, I like to invest right along with the investors. And in this deal, the sponsors will together provide over 12% of that equity. That is unusually high as industry standard goes, and hopefully that shows everyone how much we like this deal ourselves. Okay, we'll talk a little bit about sponsor compensation for this investment. As Michael mentioned, our primary compensation comes from the profit split. That's where the 80% of the operations profit goes to the investors and 20% goes to the sponsors. Obviously, we'll only receive this compensation if the project is generating profits. We will also collect a few fees for this transaction, which are primarily cost reimbursements. That's the 2.5% acquisition fee to cover the myriad of costs we've incurred to put this deal together, and also covering the risky aspects of the acquisition, such as the $100,000 non-refundable deposit, $40,000 loan assumption fees, etc. If the deal doesn't close, we're going to lose these amounts, but that's the risk that the sponsors incur with no risks to the investors. We're also paying JMG Group a 1.5% broker fee for brokering this deal with the seller. This is a great savings to the investment as a whole, actually, because we're not paying the industry standard of 4 to 5% acquisition fee to a commercial brokerage firm. We're also going to have a 1% asset management fee during the operation, and this is just to cover our audit, accounting, and management type of expenses. Lastly, when and if we do refinance the property, there will be a 1% fee for the extensive work, mostly paperwork, that we're going to need to do to make that happen. By the way, the refinance is just one of the potential strategies we're contemplating at this time. In 5 years of time, we may just as well to decide to sell the property rather than to refinance, if we decide that is the optimal strategy at that time. Okay, well, last thing I will talk about before we go to Q&A, and I think we have a couple of good questions, is how to invest in this opportunity and what the next steps are. Again, this is open to accredited investors only, and that is an SEC defined term that we can explain to you later. $100,000 minimum. And if you're interested, please contact me at 650-740-5329 or my email, or also feel free to contact Felicia Fro if you are in connection with her. Our deadline for the funding is December 19th, and I encourage you to let us know immediately of your interest, because this is really not a big size deal and there's not too much room for everyone to participate. Okay, so let's see. We think we have a couple of good questions here. One of the questions that came up here is, what is the biggest risk with this investment and what could be the worst case scenario? Michael, do you want to take that one?
Yeah, can you repeat that for me, Sonia?
Sure. What is the biggest risk with this investment, and what could be the worst case scenario?
I would say the biggest risk would be if we had a market over the next 5 years that didn't have the demand that is predicted across the United States and through the Midwest for units. As construction costs have skyrocketed and the permits pulled for new product has gone down, the demand for units over the next 5 to 7 years is going to grow tremendously. And I would say that from what I've seen in the job diversity market of Evansville, that would really be the only item that I would look ahead to. And if it does happen, it would mean that our 97% predictions on vacancy might be in that 92, 93% range, and we'd still be making a good profit.
Okay.
And then what was the second part of the question?
Well, I think you were kind of answering it. What would be the worst case scenario? And it sounds like Evansville is not the type of place where there's a huge influx of population and huge exit. And so you, at the worst case scenario, you're forecasting still above 90% occupancy rate.
Yes, and that's the great part about the Midwest and Indiana. As the East Coast and West Coast see large fluctuations in rents and occupancies and cap rates, the Midwest, while they're suffering in those, has made little minor changes, and we haven't suffered the same type of market that they do. It's a safer market, and it's one of the reasons we're here.
Yeah. All right. Well, that's I think that's a good answer. I think kind of related to the second question is the risk again. Isn't there ample land in Indiana and Evansville, and what prevents competition from coming in and oversupplying housing to the market so that we lose that 97% occupancy rate?
Sure. So if you look at an area like Evansville, there are a lot of areas like where Bradford Point is that don't have extra land right around them. So you're looking at a large single family neighborhood, lots of stores and different things, and the age of the neighborhood is older. So you're not going to be building new units. And you cannot build C units and you can't build B units, you build A units. And as A units are built, they'll be built in newer areas so that the rents will pay for the construction, that high construction cost. And what normally happens is that those A prices for rent normally drag us up through the market with them. So it's actually a plus for us, not a negative. Plus the fact that construction costs are so high that you're not going to see a huge amount of apartment construction in the areas that we have workforce housing.
Yeah, we're seeing a huge increase in material cost and construction costs out here in California as well. And, you know, people sometimes don't understand that it's very difficult to build a affordable B-class apartment. You know, you're going to come and see luxury high rises, but in order to support that cost, the rent has to be substantially high. And really what we need in places like Evansville is the workforce housing and the affordable Class B apartments. And again, those are really difficult to build efficiently with the at the budget that you need to have to support the rent.
Correct.
Okay, well, I think those are the main questions we got. Again, if you have any afterthoughts or questions, please don't hesitate to direct that to us. We would be happy to answer anything and also go into more discussion as you into however depth you like. Okay, well, I appreciate everybody joining us tonight, and especially to Michael and Jerry, I know
Thank you guys.
It's really late there, so I appreciate that. And with that, we'll end this webinar.
Thank you
All
all.
right. Thank you all.
Thank you.
Have a good night.
You too.